Good afternoon, everybody, and welcome to our Thursday macro webinar. Patrick, along with Angus here today. Angus, how are you?
Yeah, good morning, Patrick. Very well, thank you.
Good, and welcome to all the members that are joining us today. It's been a couple of weeks since we've done a presentation, so we're looking forward to updating everybody on where we're at with the market. So here's your two presenters, Angus and Patrick. And what we'll do is we'll just get rid of the housekeeping items at the moment. Just disclaimer. All information is for general advice only. Before acting on any recommendations or ideas in this presentation, please be sure to consult your financial advisor or consultant, and please be aware that past performance is no indication of future returns. Comments and questions, you'll have the ability to answer type in some questions. Angus and I'll look to get them answered. You can see the orange arrow here where you can type the questions in. If you cannot hear us at any point in the presentation, please feel free to give us a call, 1-300-88-11-77, and we'll look to help you get into the presentation. So without further ado, FET Profits market update. Angus, it's been quite an interesting time, and I thought we'd start with the S&P chart here. U.S. benchmarks at record highs. What's driving it, and what is the outlook for rates?
Well, as we can see on this chart, the S&P 500's since breaking that big resistance level at 4,800 has extended higher up to new record highs. We've also had new record highs in the Nasdaq, and a lot of this has been driven by a lot of hype and euphoria around the AI wave that's coming. NVIDIA has accounted for a big chunk of the rise, and it's worth sort of highlighting that the top 10 stocks now in the US now account for 35% of the S&P 500 market cap, which is a record, not a record, but the highest proportion going back to 1972. So clearly, a handful of stocks, the Magnificent Seven, Apple, etc., have been responsible for this. I think what's helped the markets sort of make these highs this week, we've had the culmination of data pointing to a slowdown in the labour job market, and also a bit of fraying at the edges with respect to the economy, and that has allowed the bond market to rally quite strongly. We've seen those 10-year bond yields get down to 4.28%. So this was a flashing red light, as you know, a few weeks ago. So we've seen a big swing indeed, in that 10-year yield, and indeed the entire US yield curve, and that has supported, this run to record levels in the indices.
Okay, we'll move on to the Nasdaq, and I know you touched a little bit about that in the previous slide, but we'll pop up the Nasdaq composite chart here, and this looks to be breaking out as well.
Yeah, it's really for similar reasons to the S&P 500, and similarly from a technical level, it's taken the better part of 2 years for the Nasdaq to sort of consolidate a reassert to the top side, and now we've seen that sort of big resistance level at the 2021 highs broken definitively. It's been retested, around that 16,000 level, and the Nasdaq composite is now in a strong uptrend. So technicals point to upside extension, fueled by falling bond yields, with growing conviction that the Fed will be cutting interest rates by September. It's also sort of worth highlighting that Morgan Stanley's view is that the Fed will cut 3 times this year for a total of 75 basis points, with another 100 to follow next year. And what was interesting overnight, we saw the Bank of Canada cut interest rates for the first time. So that's the first major central bank in the developed world to cut interest rates.
So you touched on the US 10-year bond yield, and here we got the chart showing that, and maybe you could just make some comments on this for us, please.
Yeah, so whilst the primary uptrend in the 10-year bond yield has yet to be definitively broken, we can say that it's actually being tested quite aggressively on the downside at around that 4.3% level. It's yet to break down through that. So, the overall technical setup for the 10-year bond is still bearish. It's still bearish, but it's obviously backed away from that danger line, and it's testing, 4.6% on the upside. And, the concern was a few weeks ago that it would actually break out and reassert to the top side, in which case that would have been a red light for the stock market, because, higher bond yields pressure company valuations, they put pressure on PE multiples, and, the Russell Small Mid Cap 2000 in particular. So it'll be interesting to see what happens in coming weeks, and whether that 10-year bond yield actually breaks down below that primary uptrend. It's looking like it will, but the proof is always in the pudding, and that remains for the market to confirm.
Okay, we'll move on to gold, and I know it's something we've been talking a lot about, and I know you're still excited about the gold price and some of the gold stocks. And here's a gold chart that we will present today.
Yeah, so I think gold's looking encouraging. We've seen the 50-day moving average and that sort of primary, that near-term uptrend that sort of followed the breakout back in February. We've seen that respected. We've seen a good test around that 2,300 level, and the gold price looks to be reasserting to the top side. A couple of weeks ago, JP Morgan upgraded their long-term gold price forecasts. They upgraded the gold sector and gold equities in Australia. And we saw the same this week happen with UBS. They've been a bit more aggressive in their long-term gold price assumption, and where the gold price could go this year and next year, with a $2,800 target. And technically, there's no sign of the upward trend breaking down. So with this week's, or the reassertion to the top side, if we see some follow through, I'd be reasonably confident that we'll see the gold price challenge the record highs in the coming month or so.
And if we do see these interest rate cuts in the United States with the Fed, how do you think that'll impact the gold price?
Well, we've seen fairly sluggish activity in the US dollar, and as we know, the US dollar and the gold price have an inverse relationship. And so, a big part of our thesis for this year is that the US dollar will enter a secular bear market, and that will provide a lot of upward impetus for the gold price. Whilst we haven't seen the US dollar break down technically, it's been encouraging that gold has managed to rise in the face of that anyway. And I think what is significant to note of recent, in terms of recent trading in the markets, is that the US dollar is looking increasingly sluggish. If the Fed moves to cut rates this year, and indeed there's growing conviction that they will, then we can expect interest rate differentials with the US and the rest of the world to narrow, and that's likely to put downward pressure on the greenback, which has got to be positive for the gold price, and indeed the other precious metals, and also the broader commodity complex.
Do you think there's a catch-up coming with some of the gold producers up to the gold price? I mean, we haven't quite seen that yet, have we?
They're behaving in a fairly resilient fashion. The dips are being bought, and I guess what I'm sort of encouraged about is, number one, we've seen the gold price reassert to the top side, and that's accompanied huge outflows from physical gold ETFs. In other words, retail and institutional investors are selling, but that's been dwarfed by central bank buying. So I think that we're yet to see retail and institutional investors really begin to buy gold and precious metal equities. So I think that lies ahead of us. And that will drive a catch-up, continue to drive a catch-up rally in precious metal stocks, which are under-owned in most investor portfolios.
Okay, and now we'll move on to silver. I know it's something that you and I have been talking quite a bit about, and you're quite bullish on. And here's a very interesting chart to show that.
Yeah, so we can see that silver finally managed to clear this big historic resistance level at $29, and the follow through on the upside was pretty powerful. When it finally got through 25, through that green line. It ran quickly to sort of $33. And we've since seen that breakout level test, and it seems to be holding up quite nicely. So this favors further upside extension. I should also sort of add that UBS upgraded their outlook on the silver spot price for this year to $38. So we're seeing these investment bank broker upgrades come through. And I think so the technicals are very supportive of follow through in the silver price on the upside. So like gold, I'm anticipating this to extend higher in coming months. That's got to be good for some of those silver producers, which like their gold contemporaries continue to screen cheap on a sort of a price NPV basis.
Okay, and as we move to copper, I know you and I had a good chat about copper, and you spoke a little bit about AI and what could drive the copper price higher with a lot of these data centers and the AI rolling out.
Yeah, so technically, again, very bullish for copper. Since we called the breakout and flagged that back at 380, the price moved significantly higher, almost 50% up to May highs of around that 540 level. And, we've since seen a pullback. That's to be expected. It got overbought. There's a bit of resistance above 5. But again, this is a highly favorable, constructive technical setup. And I think that, the fundamentals are in place to support higher copper prices over the next 5 years. We're bullish on it. And the copper producers, we've got rising demand. We've got the rollout of AI, the upgrade of infrastructure that's going to be required, power demand's going up. We've got the rollout of renewables. I mean, all of that requires a lot of copper and a lot of base metals. So that's very supportive. Meanwhile, supply remains quite constricted. We haven't seen any new major mines come online. Nothing's really in the pipeline, as evidenced by the BHP bid for Anglo. It's cheaper to go out and buy existing mine supply than develop new ones. That's not going to address the supply shortages that are coming down the line in the copper market. And so I think that demand's going to continue to rise against the backdrop of tightening supply, and that's going to support a bull market in copper that could run for some time. Jeff Curry, he was the former sort of highly regarded commodities analyst at Bloomberg. He's made some big calls in the last 20 or 30 years. He has said in the past month that copper is his single most highest conviction commodity call ever. He's a massive copper bull. I did write that up in my daily note. So voices like that carry a bit of weight, and I think the copper producers are well positioned to benefit from higher spot prices over coming years.
Okay, if we move to Australia this week, we saw some poor GDP figures. Looks like the economy could potentially be on the brink of a recession, with consumer spending well down. What is the outlook for the ASX 200 at this stage, Angus?
I'm bullish on the ASX 200. It's in a new bull market, and I say that with a bit of conviction because, the 7,600 level, and indeed the 7,000 level, took the better part of 14 years to be overcome. The ASX 200 topped out at just under 7,000 back in 2007. So it's taken 14 years really for the index to really push through those big resistance levels. So we've got a decent base, and against the the noise about the economy and Australia slipping into recession, the economy can do one thing, but the stock market can do another. And I think the technical price action favours the upside in the ASX 200. So I'm quite bullish looking out over the next few years, and I think the ASX 200 is going to push well through 8,000 in that time period. But standing back and looking at the market, I am a little bit concerned about some of the tech stocks. There's only a few of them on the ASX. Some of them have got quite lofty valuations now. The bank stocks, which have helped the index, I think they're looking a lot better, but near term we might see them pull back a little bit. But what I can say with a high amount of conviction is that I think the resource sector is going to provide a lot of impetus for our market. I think we're going into a major bull market for resources, and that's going to provide a lot of lift for the ASX 200. And I don't think the valuations are anywhere near as overcooked and at the producer end of the resource market. I'm not talking about the smaller end, but the producers in particular. From the large caps such as BHP, Rio, down to some of the smaller mid cap mining houses. So I think that's going to provide a lot of lift. We've also talked in recent webinars about the banking sector also breaking out of a long-term 10-year bear market, and I think while there could be a bit of backing and filling and consolidation with some of those banks near term, their path of least resistance for that sector is higher as well. And I think together that's going to provide the lift that we need really to get the ASX 200 through 8,000 with conviction, and I think we'll see that play out over the next 2 years.
And with the poor GDP figures and consumer spending down, are there any sectors or stocks you're looking to avoid?
Well, I think that discretionary retailers are really a sector to stay away from at the moment. We know that consumers are tightening their belts. They're not spending anywhere near the same amount as they have been on restaurants, etc. They're really cutting back on that. Travel's holding up quite well, but for how long? I think there's some downside risk there. It's interesting that Virgin Australia, they're planning an IPO. Private equity are looking to getting that off the ground, and perhaps that's what they're seeing. Maybe a potential sort of downturn coming there. So yeah, I'd be staying away from discretionary retailers. I also think anything that's got a really expensive multiple on it, you've got to have a bit of caution. And I prefer the more defensive sectors at the moment, including the resources.
Okay, what's the latest on Asia? What are you seeing there, Angus? And here's the Hang Seng chart.
Well, as you know, Pat, I sort of turned quite bullish on China, Hong Kong, and see those markets really having quite a significant scope for recovery over the next few years. The Hang Seng and the CSI 300 exited technical bear markets, big bear markets where they retraced and went down, 50, 60%, where valuations bottomed out at around 6 to 8 times the forward PE, which we saw on both of those indexes at the bottom in January. And I think, the price action on the Hang Seng has been quite encouraging. We saw a bit of overextension. The index got up to 19.6, and it's since come back down and retested that support level of 18,000. That's holding nicely above that, as it is above the 50-day moving average. So, yeah, I think that those markets are going to continue to climb a wall of worry. And if there was a sort of a setback in the US, where the S&P's priced at the top end of the historical range as it relates to the forward PE, I think, you know, these markets would probably hold up quite well, you know, given that, you know, valuations have been absolutely pounded over the last 4 years. I think you can make a similar argument for the FTSE 100. You know, the PE got down to around 10 times on that index. So I sort of see that as being really defensive as well. Similar price action on the FTSE 100 as to the ASX 200 is doing. And, you know, and again, in Australia, you know, I think, you know, the ASX 200 is not overcooked in terms of its valuation. So, yeah, all in all, I'm finding international equity markets to be more defensive than the US. If there was to be a setback, and we're not seeing any technical signs of that trouble happening yet, but you know, there is some risk there with the crowding out in terms of the top 10 stocks making up 35% of the S&P 500. You know, I'd rather be in some of these quality names listed in Hong Kong that have a much more favourable valuation skew.
And one way to play it, you and I did a webinar on a managed account that you're managing at the moment, which gives investors exposure to a basket of Asian stocks that they can set up quite cost effectively. And I know you're quite excited about that Asian managed account, aren't you?
Well, we've focused on Japan, which has been very good. It's been in a bull market now for a while. And I think, you know, Japan can continue to outperform. You know, we've got a decent amount of exposure to the financials and the banking stocks, which are doing well, you know, and the Bank of Japan's now raising interest rates counter-cyclically. That's going to help the yen, support the yen, but also interest rate margins for the banks. And we've been focusing also, you know, on some of those China mainland bellwethers. I really like the big defensive IT internet bellwethers, such as, you know, such as Tencent Holdings, Tencent Music, Yum China, which is the KFC operator over there, and also Alibaba. You know, a lot of these stocks are now being able to facilitate large buybacks. They've got very strong balance sheets, lots of cash, and you're paying a fraction of the multiples that you would for a US counterpart.
Okay, and I thought we'd just touch on a few stocks, which we always get asked about, and I know we touched on resources, and here's BHP.
Well, I think BHP is a good one to start with. I mean, obviously the stocks, it has been under a bit of pressure after backing away from those record highs and that resistance level above $50. You know, when they launched the takeover for Anglo American, going after the copper assets, you know, the market saw that as a negative because it was EPS accretive. You know, they've since walked away. Doesn't mean to say they won't be back in 6 months' time. They probably will be. But I think this looks really interesting, and you know, the fact that it's, you know, sort of back in its primary uptrend, sort of says to me that this is probably a good opportunity. I think also the iron ore price is probably going to reassert to the top side as well. You know, I wrote about that this morning. The iron ore price is back at its primary uptrend. It goes back to sort of 2016. So yeah, I think there's an opportunity here. BHP is one of the world's largest copper producers. It drives a significant amount of revenue from that commodity, and they are well positioned there to benefit from the secular bull market that's coming in copper.
And one stock I know you've been looking at quite a bit, and we did introduce in the research reports 29 metals. It's now in the global mining report up on the website, but I know it's a stock that you've been keeping a close eye on, Angus.
Yeah, again, I think, you know, this chart looks technically very encouraging. We've seen a higher series of reactionary lows since March. Topside resistance around that sort of 60-cent level has been tested a number of times now, but you know, the shares are hanging in above the 50-day moving average. This is a smaller copper producer, obviously, you know, much smaller than BHP, but it's got favourable operating leverage to higher copper prices. And I think, at some point, the topside resistance level is going to be breached. That would favor a recovery and upside extension to that next resistance level just below 70 cents. We might see some backing and filling there, but I think, this stock's got the potential to get back to 90 cents, particularly if we can see, copper reassert to the upside over the coming year and climb back above $5, which is our base sort of technical case for copper spot prices.
Okay, and just to pull together a couple questions that we're getting, you're still seeing good opportunities in gold, silver, and copper? Because they seem to be the questions coming through: gold, silver, copper.
Sorry, what was that question, Patrick?
You're still seeing some good opportunities in the gold, silver, and copper sectors at this point in time. I know.
Yeah, I think there's a lot of opportunity there. I mean, we just saw UBS put a 460 price target on Evolution. They're going to have 30% of their production, whether their revenues coming from copper. I think the North Park acquisition was quite well timed. But yeah, a lot of these copper producers and the gold producers, they're on high free cash flow yields. They're generating significant, free cash flow at spot prices. Costs have been an issue, but they've been an issue for a while. And, yet we're sort of seeing, a lot of the miners sort of well down on their highs from 2021. So, that sort of says to me that there's quite a lot of catch-up potential. And as I mentioned before, Patrick, it's really under-owned by the global, not just the Australian, but the wider global community, who are very, very underweight and under-positioned in terms of, the average portfolio. So, yeah, I think there's a decent risk-reward skew there, and particularly if we see some of those spot prices, gold, silver, copper reassert to the top side, which is our base case in coming months.
Okay, and as we approach to the end of the financial year, I thought it would be a good idea if we just kind of recapped some of the benefits that the members have access to. I know that, Angus, you're up early, you write the Fat Chat in the morning, and you're providing market direction and guidance before the market opens. And I know you're quite, you're up early and you put that out pretty quickly before the market opens. So maybe you just want to touch a little bit on your note in the morning.
Yeah, I'm a big believer in the early bird catching the worm, Patrick. I've always believed that you've got to get up early, particularly in our game where, the markets are moving the whole time. They're 24/7. And of course, I always start with the US because the US is the dog that wags the tail. What happens in the US has implications for the rest of the world. Drives sentiment. It certainly drives sentiment, but it also, it impacts what's going on in the FX markets and what's going on in the bond market. Globally, all bond markets take their cue and their lead from the US bond market. So it's really important to start with that. And so I get up early really to get across what's going on in the US and build my day out from there. And yeah, I like to articulate and put my thoughts down on paper. That really helps me get organized in the morning and really sort of set the framework up for where we're going with our portfolios and what the markets are doing.
Okay, I thought I'd touch a little bit on the, just be reminded, members, that we're publishing in real time now. So visit the website where we post our buy, hold, and sell recommendations, and we're supporting those recommendations with the research team by both fundamental and technical analysis. And I know you'll see quite a few stocks that Angus covers in the morning note. You've also got access, and we encourage you to join these member-only webcasts. We do a macro webinar, which Angus and I are doing today, every other week. The research webinars on a Thursday as well. And we've got question and answer session available. Some other services we wanted to remind you of is the Friday Fat Wrap, where we send it out on the weekend and it covers most of the stuff that we've covered during the week. Also, Angus and I will do a podcast from time to time. And if we got an important stock alert, we'll send out a midweek alert to you, and you got a complete portfolio archive. If you're interested in a portfolio in wealth management services, you can contact us here, 1-300-8811-77, or you could email us at members@fatprofits.com.au. I thought Angus would touch a little bit on end of financial year. I find it hard to believe it's almost the end of June. How time flies, doesn't it?
Time certainly does fly. And you've got to literally seize every day, Pat, which is kind of why I finish each note with Carpe Diem. I can't believe either that the 24 financial years come around this quick.
Okay, so I thought we'd just pop this up. We do get a lot of questions. We do get a lot of inquiries from members that are looking to continue their subscription with Fat Profits and continue their membership. This is a good time to take a look at one of those options. If you're looking for a tax deduction, we cannot give you tax advice, but you could consult with your accountant and you could potentially get a tax deduction on any memberships that you buy at this point in time. And you can also buy it through your self-managed super fund. So we thought we'd just recap some of the membership options we have. We have the standard option where you get access to Angus's daily commentary in the morning, these weekly member-only webinars, the Friday Fat Wrap, which we spoke about, and you get to choose from one of our 3 research reports, either these Australasian equities, the global mining, or the global equities. A lot of members take the premium membership. It seems to be the most popular service that we have at this point in time. Again, you get access to Angus's morning note, the weekly member webinars, the Fat Wrap, but you get to choose from 2 of our research reports. You can have the Australasian equities, global mining, or global equities. And for those that are interested in a little bit more, they can take the Platinum membership. The Platinum membership, again, gives you access to the daily note that Angus writes in the morning, these weekly webinars, the Fat Wrap, but you can have access to all of our research reports, Australasian equities, global mining, and for those of you who are looking for some international diversification outside of mining, you got the global equities service that you can also get access to. So given it's always this time of year, end of financial year, we get a lot of questions about membership options. We do have some special promotions on at the moment. So we're going to pop a little bit of a poll up here. If you're interested in any one of these packages, please click on them, and we'll endeavor to get in touch with you to try to help work out a good opportunity for you. And as I said, we do have some good promotions on for end of financial year. So I'll just leave this poll up for a second. We've got people clicking on the poll, and again, as always, it seems to be the premium membership that most members go to. So I'll just leave that up for a second, Angus, because we still got a couple members expressing interest in these packages. Okay, I think that does it. I think we've had a number of people express interest, so we'll close the poll now. That's closed, and we will move on to our next concluding slide, which is, again, if you're interested in end of financial year special offers and the membership may be tax deductible, please get in touch with us, or you selected one of the options in the poll. So that basically covers it for today. I thought we had a good presentation. Angus is always asking, is there any key data or any key information you're keeping your eye out on for next week?
Yeah, we've got the non-farm payrolls. This is a biggie. It'll provide a window into how the official labour market, well, it's the most official statistic, the pertinent statistic, which will provide us a window into how the labour market's looking. We've had a lot of surveys and peripheral data at the edges confirming a slowdown. So that's going to be a big one to watch on Friday. We've also got the FOMC meeting next week. And, given that, some of this data has been quite soft, given the benign PCE inflation gauge from a week ago, it'll be interesting to hear what Jerome Powell's got to say next week. But I think that the case for the rate cuts is there, and it'll be interesting. It's really the next catalyst for the markets. But I think Jerome Powell will probably be supportive of moving to cut rates sooner rather than later. The market's looking for September, and we will know more next Wednesday.
Okay, well, that will conclude it for today. I'd like to thank all the members who joined us today. And Angus, as always, thank you. And we'll say bye for now.
Thanks, Pat. Bye for now.